Ever wondered what makes certain investors stand out from the crowd? Well, in the world of investing, few names shine as brilliantly as that of Peter Lynch. As the manager of the Magellan Fund at Fidelity Investments between 1977 and 1990, Lynch averaged an annual return of nearly 30%, making him one of the most successful stock market investors of all time. His approach, often referred to as the Peter Lynch way of investing, breaks down the complex world of stock investing into a series of practical and applicable strategies. In this video, we're going to delve into 10 key takeaways from Lynch's investing philosophy. From understanding the importance of investing in what you know, to the wisdom of long-term investing, each takeaway provides a unique insight into the mind of this investing maestro. So buckle up, prepare your notepad, and get ready to learn from the master himself. Let's dive into the unique world of Peter Lynch, shall we? Peter Lynch's first rule of investing is simple, yet profound. Invest in what you know. It's a principle that has guided many successful investors. Lynch firmly believes that personal expertise and understanding can give you an edge in the investing world. If you're a tech geek, you might have an advantage investing in tech stocks. If you're a fashion enthusiast, you might know which retail brands are likely to succeed. This concept of investing in familiar territories is about leveraging your knowledge and staying within your comfort zone. It's about recognizing opportunities in everyday life, long before they become apparent to the Wall Street crowd. Lynch's rule isn't about restricting your portfolio, but rather about optimizing it based on your unique insights and experiences. An investment isn't just a number on a screen, it's a stake in a real business. And who better to judge the potential of a business than someone who understands it? As Peter Lynch wisely puts it, if you stay half alert, you can pick the spectacular performers right from your place of business or out of the neighborhood shopping mall, and long before Wall Street discovers them. The second takeaway from Lynch's approach is to do your own research. It sounds simple, right? But it's surprising how often this fundamental step is overlooked. You see, it's easy to be swayed by the opinions of others, by the latest headlines, by the chatter in the break room. But investing isn't about following the crowd. It's about making informed decisions based on your own understanding and analysis. To do this, you need to dig deep. Look at a company's financial health, its competitive position, its growth prospects. Listen to earnings calls, read annual reports, keep an eye on industry trends. Be your own detective. And remember, this isn't about trying to predict the next hot stock or time the market. It's about finding solid companies that you believe in, that you understand, and that you think are undervalued. Doing your own research isn't just smart, it's essential. Remember, there's no substitute for doing your own homework. Lynch's third advice is to look for growth stocks. But what are growth stocks, you might ask? Well, they are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. They often do not pay dividends as they reinvest their earnings back into the business to spur further growth. Lynch believes that these stocks are a good investment because they offer the potential for significant capital appreciation. The logic is simple. As the company grows, so does the value of your investment. It's like planting a sapling and watching it grow into a mighty tree, with each leaf representing $1 added to your investment. However, it's important to note that growth stocks can also be riskier than average. They often have high price-to-earnings ratios, indicating that investors are expecting high future growth. If this expected growth doesn't materialize, the stock's price could fall dramatically. Growth stocks can provide great returns if chosen wisely. The fourth takeaway from Lynch is, don't fear market fluctuations. It's easy to get spooked when the market takes a nosedive. But remember, fluctuations are a part of the game. Think of them as the heartbeat of the market. It's what keeps it alive, pushing it to evolve and grow. Instead of fearing these swings, savvy investors use them to their advantage. When prices drop, it's an opportunity to buy quality stocks at a discount. And when they rise, it's a chance to reap the rewards of your prudent investments. This is not to say that market volatility should be taken lightly. It's important to stay informed and make decisions based on solid research, not emotions. But don't let fear keep you from seizing opportunities. As Lynch says, the key to making money in stocks is not to get scared out of them. Embrace the fluctuations, play the long game, and watch your portfolio grow. Patience is a virtue, especially in investing. This is Lynch's fifth takeaway. It's a common misconception that successful investing is all about making quick, timely decisions. However, Lynch argues that the real secret to successful investing is patience. You see, it's not about timing the market or jumping on the next hot trend. It's about investing in solid, well-researched companies and then patiently waiting for the fruit to ripen. What does this mean? It means holding on to your investments during market fluctuations and not panic selling at the first sign of trouble. It means resisting the temptation to cash in on short-term gains and instead keeping your eyes on the long-term potential. It's about understanding that the most significant returns are often reaped over years, not weeks or months. It's a simple concept, but it's not easy. It requires discipline, restraint, and most importantly, patience. So, the next time you're tempted to make a hasty decision, remember Lynch's advice. Remember, good things come to those who wait. Lynch's sixth advice is to avoid hot stocks. Now that might leave you scratching your head thinking, aren't hot stocks where the money is? Well, not necessarily. You see, hot stocks are often those that have seen a rapid increase in popularity and price. They're the talk of the town, the darling of the moment. But here's the catch. They're often overvalued due to this hype. By the time you hear about them and decide to invest, you're likely buying at a premium. And as the hype dies down, so does the price. This can cause significant losses. Remember, investing isn't about chasing the next big thing, but about making informed decisions based on intrinsic value and long-term potential. So instead of getting swept up in the thrill of hot stocks, focus on finding solid companies that may be undervalued or have steady growth potential. Hot stocks can cool off quickly, leaving you with a loss. The seventh takeaway from Lynch is don't over-diversify. While it's true that diversification can shield you from the volatility of the market, over-diversification can actually be a hindrance. Imagine this. You're at a buffet. You want to taste everything, so you pile your plate with small bits of every dish. But in doing so, you're not really savoring anything to its fullest. The same applies to your stock portfolio. When you spread your investments too thinly across too many stocks, you dilute the impact of a single stock's performance on your overall portfolio. It's like watering down your favorite drink. Sure, you'll have more of it, but the taste won't be as strong. Moreover, managing a highly diversified portfolio can be time-consuming and complex. It's difficult to stay informed about every stock you own and to make timely decisions. Remember, it's not about owning a piece of every company, but about owning the right companies in the right amount. Diversification is important, but overdoing it can vilify your gains. Lynch's eighth advice is the classic investing mantra, buy low, sell high. This principle, as simple as it may sound, is often challenging to implement. It requires understanding the market cycle and recognizing the right time to enter and exit a particular investment. But how do we determine when a stock is low or high? This is where the importance of doing thorough research and analysis comes in. When you've done your homework, you can identify the intrinsic value of a company and compare it to its current market price. It's also crucial to not let emotions cloud your judgment. Fear and greed can lead to buying high out of FOMO, fear of missing out, and selling low due to panic. Instead, stay calm, stick to your strategy, and make rational decisions. In essence, buy low, sell high is about making informed decisions, not following the crowd, and keeping your emotions in check. Remember, buying low and selling high is the key to making a profit in stocks. The ninth takeaway from Lynch is don't follow the crowd. Often we're tempted to ride the wave of popular opinion, especially in the world of investing. But remember, the crowd isn't always right. In fact, it's usually when everyone is buying that it's time to sell, and vice versa. Think of it this way, the market is like an auction house. If everyone is bidding on the same item, the price goes up, sometimes far beyond its actual value. That's when bubbles form and inevitably, they burst. Instead, Lynch advises to form your own opinions, based on diligent research and understanding. Don't get swayed by what everyone else is doing. If you've done your homework and believe in the potential of a company, that's when you invest, not when everyone else is doing it. In the end, it's about being patient, being informed, and trusting your own judgment. Stand out from the crowd and make your own investment decisions. Last but not least, Lynch's 10th and final advice is to invest for the long term. The idea here is simple, yet profound. The stock market, with all its ups and downs, has historically offered a higher return than any other investment over the long haul. It's like planting a seed and patiently waiting for it to grow into a mighty oak. Sure, there will be storms and droughts, but the tree is resilient. It doesn't worry about the daily weather, it's in for the long haul. Similarly, when you invest for the long term, you're not swayed by the daily fluctuations of the market. You're focused on the bigger picture, the long-term growth potential of your investments. That's why Lynch advises, invest for the long term. It's not about timing the market or chasing after the latest hot stock. It's about making smart, informed decisions and having the patience to let your investments grow. Remember, Rome wasn't built in a day, and neither is a successful investment portfolio. So there you have it, the 10 takeaways from Peter Lynch's approach to investing. We've journeyed through the importance of investing in what you know, conducting your own research, and seeking out growth stocks. We've explored the need to keep a steady hand in the face of market fluctuations, to exercise patience, and to steer clear of the allure of hot stocks. We've also navigated the perils of over-diversification, the timeless strategy of buying low and selling high, and the wisdom of not blindly following the crowd. Above all, we've underscored the value of investing for the long term. These tenets, distilled from Lynch's extensive experience and success, serve as a practical guide to navigating the world of stocks and investments. As Peter Lynch once said, "In the stock market, the most important organ is the stomach, it's not the brain." So trust your gut, do your research, and happy investing.